Endeavour Mining plc is a leading global gold producer, holding the preeminent position as the largest gold producer operating exclusively within the West African region. The company has strategically amassed a diversified portfolio of operating assets across three key nations: Senegal, Côte d'Ivoire, and Burkina Faso. This portfolio is unified by its focus on the highly prospective geology of the Birimian Greenstone Belt, a key region for global gold discovery. Operations include the cornerstone Sabodala-Massawa mine in Senegal, which has recently undergone an expansion targeting production above 300,000 ounces per year, alongside operations such as Houndé and Mana in Burkina Faso, and Ity and the recently commissioned Lafigué mine in Côte d'Ivoire. To ensure robust access to global capital, Endeavour maintains a dual listing on both the London Stock Exchange (LSE) and the Toronto Stock Exchange (TSX) under the symbol EDV. This positioning grants the company high liquidity and visibility among international institutional investors. The company is also a committed member of the World Gold Council, signaling its adherence to principles of responsible mining. The fundamental investment case for Endeavour is defined by a dichotomy: the presence of exceptional operational quality, characterized by sector-leading costs and robust cash generation, offset by a substantial, structurally applied valuation discount derived from its complete exposure to the geopolitical complexities of its operational region. 1.2. Quantitative Summary of Investment Strengths, Fiscal Year 2024 Performance. Fiscal year 2024 demonstrated Endeavour's superior operational execution and accelerating financial momentum. The company achieved a strong production profile, totaling 1,103,000 ounces for the full year. Critically, this production was achieved at an all-in sustaining cost (AISC) of only $1,218 per ounce. This cost performance confirms Endeavour's standing as one of the lowest-cost senior gold producers globally. The favorable cost structure and strong production volume translated directly into powerful financial metrics. Endeavour delivered an adjusted EBITDA of $1.325 billion for FY24. Furthermore, the company successfully pivoted to a cash flow generation model, highlighted by a record free cash flow (FCF) of $268 million, or $1.10 per share, generated in the fourth quarter of 2024. This financial strength is complemented by a conservative capital structure, with net debt reported at $732 million, yielding a very manageable leverage ratio of 0.55x net debt to adjusted EBITDA (LTM). Management is proactively targeting a further reduction in this ratio to the long-term goal of 0.50 in the near term. 1.3. Key investment constraints and the geopolitical discount. While the operational and financial fundamentals of Endeavour are demonstrably strong, the primary constraint on equity valuation is the high geopolitical risk associated with its 100% operational concentration in West Africa. The region, particularly nations like Burkina Faso, has faced heightened political instability and security challenges. This jurisdictional exposure has a measurable impact on the company's market valuation. The market currently assigns Endeavour an LTM enterprise value to EBITDA multiple of approximately 5.1x. This valuation is materially lower than the multiples commanded by senior North American peers, such as Newmont Corporation and Barrick Gold Corporation, which trade at 7.1x and 8.7x respectively. This gap in valuation multiples quantifies the premium the market demands for perceived geopolitical safety, effectively creating a structural valuation discount that must be critically assessed by any potential investor.
Section 2. Operational Excellence and Comparative Cost Structure Analysis. 2.1. Fiscal Year 2024 Production and Cost Performance. Endeavour Mining reported full-year production for 2024 totaling 1,103,000 ounces, with an all-in sustaining cost (AISC) averaging $1,218 per ounce. This cost performance places the company firmly within the top quartile of global gold producers. However, the reported AISC for the full year did marginally exceed the initial guidance range provided by the company. This variance was not attributed to a single factor, but rather a combination of specific operational challenges and broader economic and fiscal pressures. First, the cornerstone Sabodala-Massawa mine experienced lower than anticipated production, coupled with higher than expected costs. Second, the company faced general inflationary pressures, specifically higher power costs across the portfolio. Third, and crucially, higher royalty costs contributed to the elevated unit costs. These royalty costs increased directly because of the prevailing high gold price environment, as many regional fiscal regimes employ a progressive royalty structure that captures a greater share of revenue upside when the gold price is high. This structural cost increase linked to the price of gold confirms that host countries are progressively participating in the margin expansion, placing an inherent limiter on the benefit realized by the operator from rising metal prices. 2.2. Q4 2024 operational inflection. A significant development in the operational profile occurred in the fourth quarter of 2024, demonstrating strong execution momentum. Production in Q4 reached 363,000 ounces, representing a considerable 34% increase over the production reported in the preceding third quarter. This volume acceleration drove significant efficiency gains. The Q4 AISC decreased by approximately $147 per ounce, settling at a highly competitive $1,141 per ounce. This sharp reduction in unit costs toward the end of the fiscal year signaled a successful return to expected efficiency levels, suggesting that the operational setbacks and cost inflation experienced earlier in the year were being actively managed and overcome. 2.3. Competitive benchmarking, quantifying the cost advantage. The achieved cost structure of Endeavour provides a substantial competitive advantage when benchmarked against global peers. The FY 2024 AISC of $1,218 per ounce is significantly below the global average AISC of approximately $1,456 per ounce, as recorded in the third quarter of 2024. Furthermore, when considering the company's regional exposure, its cost efficiency is even more pronounced, undercutting the average AISC for the Africa region, which stood at $1,532 per ounce in Q4 2024.
The operational leverage derived from these low costs is particularly relevant when comparing Endeavour to producers in developed market jurisdictions. In 2024, the average AISC in the United States rose to $1,716.15 per ounce, and in Canada, it reached $1,512.76 per ounce. This stark cost differential, often exceeding $300 to $500 per ounce compared to North American peers, is crucial. This superior margin cushion is the most robust defense mechanism available to the company against multiple risks, including inflation, unexpected operational setbacks, and moderate retreats in the gold price. This deep margin buffer fundamentally de-risks the cash flow statement, ensuring that even assets located in jurisdictions with higher perceived risk remain economically robust relative to higher-cost mines in safer regions, validating the quality of Endeavour's West African asset base. 2.4. Operational Outlook and 2025 Guidance. Management forecasts continued operational success and growth for the immediate future. Production guidance for fiscal year 2025 is set between 1,110,000 ounces and 1,260,000 ounces, representing a potential year-over-year production growth of up to 15%. The anticipated cost structure for 2025 is guided to range from $1,150 to $1,350 per ounce in AISC. This guidance range is slightly broader than previous years, an implicit acknowledgement by management of the persistent volatility in input costs, such as power and reagents, and the continuing potential for higher royalty payments should the elevated gold price environment persist. The successful completion and ramp-up of the expansion at the Sabodala-Massawa mine, targeting production above 300,000 ounces per year at a sector-leading AISC, remains an integral factor in achieving the upper end of both production and cost guidance. Section 3. Financial Robustness and Capital Structure. 3.1. Financial Performance and Earnings Quality. Endeavour's focus on high-margin ounces translated into strong financial performance throughout the year. For the full fiscal year 2024, the company generated adjusted EBITDA totaling $1.325 billion. The acceleration of profitability was notably strong in the latter half of the year. Q4 2024 adjusted EBITDA reached $546 million, marking a substantial 72% increase over the third quarter of 2024. This strong operational delivery resulted in FY 2024 adjusted net earnings of $227 million, equating to 0.93 cents per share. The fourth quarter alone contributed $110 million in adjusted net earnings, or 0.45 cents per share, representing a 49% increase over the previous quarter. 3.2. Free cash flow and deleveraging strategy. The company's successful pivot toward maximizing cash flow generation is a critical component of its investment narrative. Management strategy successfully delivered a free cash flow inflection point starting in Q3 2024 and culminated in a record Q4 2024 FCF of $268 million. This record quarterly performance brought the total FCF generated in the second half of 2024 to $365 million. This high level of cash flow generation confirms that Endeavour has structurally transitioned past its major capital-intensive growth phase, such as the construction and ramp-up of new mines like Lafigué. The company has shifted from being a capital consumer to a powerful generator of capital, which provides significant financial optionality and reduces the pressure on the balance sheet. This strategic shift facilitated rapid deleveraging. Endeavour maintains a conservative capital structure, reporting net debt of $732 million at year-end. The resulting leverage ratio is a low 0.55x net debt to adjusted EBITDA (LTM). Management has clearly stated its intention to reach its long-term target leverage ratio of 0.50x in the near term. The maintenance of such a low leverage ratio is a crucial mechanism for buffering the company's operational risks with financial safety, ensuring that cash flow remains available for robust shareholder distribution rather than excessive debt servicing, thus providing material resilience against regional economic volatility or unanticipated political events. 3.3. Comparative Valuation Assessment. Despite exhibiting high operational quality, strong cash flow, and a conservative balance sheet, Endeavour's equity trades at a significant discount to its peer group. The company's valuation is reflected in an LTM enterprise value to EBITDA multiple of 5.1x. This multiple contrasts sharply with those observed in the most established senior gold producers. For example, Newmont Corporation commands an EV to EBITDA multiple of 7.1x, while Barrick Gold Corporation trades at 8.7x. This sustained and deep discount, which ranges from approximately 28% to 41% relative to the two largest global gold majors, explicitly validates the market's punitive assessment of Endeavour's jurisdictional risk. However, this discrepancy also frames a core investment opportunity. The company is exceptionally cheap on prevailing cash flow metrics relative to its peer set. This suggests that the investment premise is intrinsically linked to the long-term assessment of governance stability in its West African host nations. Any sustained period of geopolitical calm, coupled with continued operational outperformance, holds the potential to narrow this valuation gap and drive significant multiple re-rating. Section 4. Organic Growth Pipeline and Resource Longevity. 4.1. Excellence in Exploration and Resource Discovery. Endeavour's long-term sustainability is underpinned by a successful strategy focused on organic growth, specifically targeting the discovery and delineation of high-margin gold ounces within its extensive exploration land package in West Africa. The effectiveness of this strategy is evidenced by the company's exploration success. Endeavour has achieved its ambitious target of discovering 12 to 17 million ounces of measured and indicated M&I resources by 2025, having delineated 12.2 million ounces since 2021. Importantly, this resource addition was accomplished at an outstanding industry-leading discovery cost of less than $25 per ounce. The ability to replace and expand the resource base at such a low capital cost is paramount, as it guarantees that new projects entering the development pipeline will inherently possess high margins. This operational foresight ensures that future production capacity will maintain or improve upon the company's current class-leading AISC profile, reinforcing its long-term competitive edge and freeing up current free cash flow for immediate distribution to shareholders.
4.2. Mineral Reserve Profile and Mine Life Visibility. The successful exploration efforts have directly translated into a robust mineral reserve base, providing material visibility into future production. As of December 31, 2024, group reserves increased by a substantial 32%, equating to 4.5 million ounces net of depletion, resulting in a total proven and probable reserve base of 18.4 million ounces. Significant additions were recorded across the portfolio, notably at the Ity mine, plus 1.2 MOZ, and the future Assafou project, plus 4.1 MOZ. This consistently successful resource replacement underpins management's goal of ensuring mine life visibility exceeding 10 years across its operating portfolio. The longevity provided by the reserve profile is a key factor differentiating Endeavour from producers facing reserves attrition. 4.3. The Tier 1 Assafou Project Catalyst. The Assafou project stands out as the primary near-term organic growth catalyst. Classified as a Tier 1 asset, its definitive feasibility study, DFS, is currently on track for completion in late 2025 to early 2026. Once operational, Assafou is projected to be a major contributor, expected to average 329,000 ounces per annum over its initial 10 years of operation. The successful development and commissioning of this project will further concentrate Endeavour's production base in Côte d'Ivoire, given the large reserve additions recorded there. This strategic concentration of new production capacity in a jurisdiction generally viewed as having a more stable political environment than parts of Burkina Faso is a deliberate strategy to secure higher quality ounces in a lower risk operating environment within the West African footprint. While this move amplifies single country risk within Côte d'Ivoire, it concurrently reduces exposure to the volatility radiating from the Sahel region, representing a calculated trade-off to buttress the overall quality and security of the production profile. Section 5. Capital Allocation Strategy and Shareholder Value Creation. 5.1. The Updated Capital Returns Mandate. Endeavour has formalized its transition to a cash flow generation phase by implementing a comprehensive and updated shareholder returns program. This strategy signifies a formal corporate shift toward prioritizing the distribution of capital rather than exclusively retaining earnings for internal growth projects. Under this commitment, the company has pledged to return a minimum of $435 million to shareholders over the two-year period, spanning 2024 and 2025. This minimum return program includes defined minimum dividends of $210 million for FY 2024 and $225 million for FY 2025. The disciplined approach to distributing capital is fundamental to addressing long-standing investor concerns regarding the security and repatriation of cash generated in emerging markets.
5.2 Review of Fiscal Year 2024 Shareholder Distributions. In its first year of the updated policy, Endeavour demonstrated a strong commitment to shareholder reward. The company delivered total shareholder returns of $277 million in FY 2024. This total significantly exceeded the minimum commitment for the year by 32%. The total return package was equivalent to a highly competitive $251 for every ounce of gold produced during the year. The composition of these returns included a record dividend of $240 million and a further $37 million deployed through opportunistic share buybacks. Since the inception of the enhanced returns policy in 2021, total shareholder distributions have amounted to $1.2 billion, exceeding the minimum commitment by 82%. 5.3 Supplemental Returns and Gold Price Sensitivity. A defining feature of the capital allocation framework is the direct tie between supplemental shareholder returns and the realized price of gold. The policy mandates that additional supplemental returns, which may take the form of increased dividends or opportunistic share buybacks, are triggered when the prevailing gold price exceeds a threshold of $1,850 per ounce and the company maintains a healthy financial position. This mechanism provides investors with direct, measurable leverage to a sustained high gold price environment. The active nature of the commitment is confirmed by the year-to-date 2025 share buyback activity, where $22 million was executed, representing a 69% increase over the comparative period in the prior year. By formally committing to return a large, measurable portion of free cash flow to international shareholders immediately, management alleviates concerns about cash becoming trapped or restricted by local capital controls or sudden changes in sovereign policy. This disciplined policy execution reinforces confidence in the quality and accessibility of the cash flow generated from the West African operations. Section 6. Jurisdictional Risk, Geopolitical Exposure, and Mitigation Strategies. 6.1. The Geopolitical Headwind and Regional Instability. Endeavour's exclusive concentration in West Africa necessitates a rigorous analysis of jurisdictional risk. The region, particularly the Sahelian nations where some of its largest assets are located, such as Burkina Faso, is noted for significant political instability. These geopolitical factors are not merely hypothetical. Industry projections suggest that regional gold production may decline between 2025 and 2030, influenced in part by this instability. Endeavour's commitment to the region, despite these challenges, requires a proactive stance on security and governance concerns. 6.2. Asset concentration and single-point vulnerability. A strategic risk management decision by the company involves increasing its exposure to the perceived stability of Côte d'Ivoire. With the Ity and Lafigué mines, Côte d'Ivoire is expected to contribute approximately 45% of the company's total production in 2025. While this move strategically reduces exposure to higher instability areas, it simultaneously creates a material single-country concentration risk. The inherent vulnerability of high single-country concentration is demonstrated by external sector events, such as the operational shutdown of First Quantum Minerals' Cobre Panama copper mine in November 2023. That single asset accounted for approximately 45% of First Quantum's total production, and its closure resulted in a massive corporate production decline from 707.6 thousand tons in 2023 to 431,000 tons in 2024. Endeavour's strategic emphasis on Côte d'Ivoire thus represents a calculated trade-off, substituting broader regional diversification for reliance on the relatively greater economic and political stability of a coastal nation, but amplifying the potential severity of loss should that country's conditions suddenly deteriorate.
Section 7. Valuation Context and Analyst Sentiment. 7.1. Relative Valuation Metrics in Detail. The valuation gap remains the central paradox of the Endeavour investment case. The company's LTM enterprise value to EBITDA ratio stands at 5.1x. This is significantly depressed relative to global senior peers. For comparison, Newmont Corporation trades at 7.1x EV/EBITDA, and Barrick Gold Corporation trades at 8.7x.
This persistent discount, where the market discounts Endeavour's earnings stream by between 28% and 41% compared to the sector leaders, is not a reflection of poor operational or financial performance, but rather an institutional premium placed on jurisdictional certainty. The deep divergence between superior fundamentals, low AISC, high free cash flow generation, and a proven growth pipeline, and the discounted valuation suggests a market inefficiency driven by behavioral bias rooted in geopolitical risk aversion. For investors willing to underwrite this geopolitical exposure, the low EV/EBITDA multiple suggests a compelling margin of safety on the underlying highly profitable assets. 7.2. Analyst consensus and price target dynamics. Despite the valuation discount, institutional analysts remain broadly constructive on Endeavour's future prospects. The analyst consensus rating is a strong buy based on reports from 15 contributing analysts. Of the 5 Wall Street analysts reporting ratings in the last 12 months, the consensus rating is buy, with 2 strong buy ratings and 1 buy rating. Recent upgrades and higher price targets reflect improved conviction in the company's trajectory. Bullish analysts emphasize the substantial upside to production, with expectations for approximately 25% gold output growth by 2030, supported by improved margins against a higher long-term gold price backdrop. These analysts see the current share prices underestimating the company's inherent leverage to elevated gold prices and the successful execution of its project pipeline. Major institutions, such as JP Morgan, have signaled confidence through overweight and buy stances, while bearish analysts highlight the structural valuation discount warranted by the concentrated West African exposure. The general sentiment indicates that operational strength and expected growth should drive an eventual narrowing of the valuation gap.
Section 8. Concluding Synthesis. 8.1 Integrated Risk-Reward Assessment. Endeavour Mining plc has successfully completed its transformation into a highly efficient, cash-generative senior gold producer. The company consistently delivers top-tier operational metrics, evidenced by the FY 2024 AISC of $1,218 per ounce, and the accelerating free cash flow profile, achieving $268 million in FCF in Q4 2024. This performance is buttressed by a highly conservative capital structure, with leverage at 0.55x net debt to adjusted EBITDA, providing substantial financial resilience. Furthermore, the company's internal exploration capability is world-class, consistently adding reserves at a discovery cost of less than $25 per ounce, which secures the long-term margin profile and provides over a decade of production visibility. The primary systemic risk remains the 100% concentration of assets in West Africa, a risk that the market quantifies severely via an EV to EBITDA multiple of 5.1x, representing a significant discount to peers. Management is mitigating this through rigorous ESG practices to secure its social license, and by structurally committing to rapid capital returns, guaranteeing the repatriation of at least $435 million to shareholders over the 2024-2025 period. The company is also strategically shifting its production center toward the more stable operating environment of Côte d'Ivoire with the Assafou project, demonstrating active risk management within its core region. The investment thesis hinges on the fundamental belief that the demonstrable operational superiority and financial conservatism of Endeavour provide a sufficient margin of safety to absorb the embedded geopolitical risks. The company offers a uniquely leveraged proposition. The current valuation anomaly presents a mechanism for significant capital appreciation should political stability hold or improve, allowing the multiple to re-rate toward the industry mean. The combination of the lowest all-in sustaining costs among senior West African peers, a committed and structured shareholder returns policy linked to the gold price, and a proven ability to replace and grow its reserve base at minimal cost renders the equity compelling. The analysis concludes that the fundamental strengths outweigh the structural geopolitical discount, positioning Endeavour as an asymmetric investment play on both operational excellence and a sustained high-price environment for gold.